Good morning. Welcome to Market Monday. Lots to get into today, so let's go ahead and jump right in. In the last 2 weeks, we had some bank failures, specifically 3 banks, which we'll get into in a minute. But first, we wanted to address the safety and security of your accounts. The investment company your accounts are held with is called a custodian. They custody your assets. They produce statements and tax forms, process trades, send and receive money, and account for your securities. Importantly, your securities or investments are held in your name. Maybe it's your trust, but it's registered to you. Those assets are held separately from your custodian's balance sheet. So even in the event of a failure, a bankruptcy, or some other adverse event, your securities would still be registered in your name, and we would then transfer those accounts to another custodian. It's natural to have questions or concerns around the safety of your investment accounts. If you do have further questions or concerns, we are here for you. Please do not hesitate to reach out to your service team, and we will spend the time to address all of your questions or concerns.
Turning to what prompted this in the first place, as Matt mentioned, there were 3 bank failures in the past 2 weeks, specifically 3 banks: Silicon Valley Bank, which we'll call SVB, Signature Bank, and Silvergate Capital. It's probably been a while since we've heard about bank failures, but they actually do happen more than we think. This is from the FDIC itself, showing the number of bank failures and assets of the bank failures. We can also see that SVB and Silvergate were among the largest failures in US history.
Yes, SVB was $200 billion plus in deposits, and they are number 2 measured that way. But in relevant economic impact, what really matters, SVB, for example, was only about 4% as big relative to the economy size in 2023 versus, for example, what Bank of the United States was when it failed in 1931. That's despite the fact that SVB was roughly 1,000 times bigger in dollars than New York's Bank of the United States. Relative to contemporary GDP, Signature and SVB were smaller than 1984's continental Illinois failure. Always crucial to add context. So what happened? It was a classic run on the bank, with depositors racing for the exits, attempting to withdraw $42 billion in a single day. Why? As the name implies, Silicon Valley Bank primarily served the tech and venture capital sectors. A few years ago, during the bull market or bubble market, a virtually endless fundraising cycle led to an explosion of deposits. When companies raised tens and hundreds of millions of dollars, they had to go somewhere, right? They're not going to stuff it under a mattress. So in a bank it went.
So it goes in the bank, and what does the bank do with it? Well, a couple things. They loan it, they invest it. SVB in particular invested it in risk-free intermediate government bonds. So they pay essentially 0 on my deposit, but take my money and earn something, a couple percent, on intermediate government bonds. When we say risk-free, we mean backed by the full faith and credit of the US government. Hold it to maturity, and you're guaranteed by the federal government to get your money back.
But as we saw last year, as interest rates rose, it severely depressed bond values. Remember, we're currently in the midst of the longest and deepest bond drawdowns in history, by far. That's part of what made last year so tough. But all good, right? Guaranteed to be paid back in full, just have to hold on. Well, in the case of SVB, its unique customer base receiving large capital investments, cash infusions, caused a large portion of the bank's deposits to be over the FDIC limit of $250,000. So the tech bubble crashes, venture investments dry up, and SVB's deposits turn into withdrawals. At the same time, its loan portfolio was probably taking some hits.
Meanwhile, the stock analysts, everyone wants to know what the analysts think. Well, have a look. Here's Goldman and Wells Fargo, Raymond James, Truist, and Maxim Group. What about the rating agencies? Here's Moody with a credit rating of A just days before the bank failed. How about the media? Forbes on Monday, March 6th, 4 days before the bank failure. One of America's best banks for 2023. You can't make it up. But that's not all. Forbes gurus favor these two banks. The other two banks that failed as recently as Wednesday, March 8th, just 2 days before the failures. Gurus, they should be ashamed.
But to be fair, SVB didn't invest customer deposits in speculative assets. They invested in risk-free treasury bonds. So venture tech crashes, and being such a tight-knit, homogenous community, the whispers act like kindling that catches fire and causes mass withdrawals of $42 billion in a single day. So SVB has to sell these bonds here at a steep loss to cover some withdrawals. But when the bank couldn't honor withdrawals, Fed stepped in and essentially took over the bank.
In recent days, the Federal Reserve and FDIC said they would not only cover the FDIC limit of $250,000, but they would also cover all deposits, even those in excess of FDIC limits. They also created the new Bank Term Funding Program, which allows banks to post their long-term bonds as collateral, but to receive full par value even though they have unrealized losses. This largely contained widespread panic in the US banking sector. Why didn't they offer this to Silicon Valley Bank in the first place? That is a good question.
All right, there's a common saying that the Fed keeps hiking rates until something breaks. Now that something has broken, that begs the question, will the Fed keep hiking? Their next meeting is just 2 days away, this Wednesday on March 22nd. And they're in a tough spot. We've got this bank thing going on, which understandably has folks on edge. February inflation also came out last week at 6% year over year. And while trending lower, the white line here, that's headline CPI, still higher than the Fed wants. Of course, energy is a lot lower, almost flat. Food seems to be holding steady at 1.4%, goods at 0.3%, but services at 4.1%. What's the largest contributor to services? Rents, specifically owner's equivalent rent. Remember that? Where homeowners are asked what their home would rent for? Yep, not rolling over. Still almost vertical at 8%. Folks, this is 34% of CPI.
And if we go back to CPI and look at core, which strips out food and energy, we get a 5.5% core CPI for February. Here's that same 5.5% core CPI, this blue line here. Here in orange is the same blue line, but instead of using owner's equivalent rent, that sharp line there, it uses current housing data, which produces a negative core CPI, meaning price declines for a 5th month in a row. Thanks for watching. Hope you have a great week.